Have you ever wondered why one country's strategic control over rare earth elements and advanced semiconductors could completely change the way we look at global political power?
It's a really fundamental question, isn't it? Because it's more than just a shift. It feels like a whole redefinition of power for this century. And the analysis we've been looking at, it makes a very strong case that the fallout from those 2018 U.S.-China trade tensions, it wasn't what anybody really expected.
That's right. So our mission today really is to analyze how U.S. policy may be driven by, ego or short-term thinking, how it fundamentally misread China's strategic position.
Yeah, the core idea is that these actions maybe inadvertently actually push China faster towards tech independence and maybe greater global influence too.
So we need to figure out who really holds the cards now, who has the leverage.
Exactly. Because the old assumptions, based on just being the biggest buyer, they might not hold up anymore. It's a classic case of, let's say, strategy versus impulse.
Okay. Before we dive deeper, don't forget to hit that subscribe button and support Geo9. All right, so let's set the scene. 2018. The official narrative, it seemed pretty straightforward back then.
It did. Tariffs, boycotts, a lot of strong rhetoric.
All aimed to getting a quick win for the U.S., right? Making China sort of bend to Washington's will.
There was this conviction, it seemed, that being the world's biggest consumer automatically meant you dictated terms.
Well, doesn't that make sense on some level? If you're the number one customer?
It sounds logical.
Right.
That's where the fatal strategic error came in. It was based on a complete misread of the opponent.
How so?
Well, the U.S. seemed to treat China like it was just a passive supplier, the world factory that you could bully.
Right, just crank out goods on demand.
Exactly. But they failed to recognize that this factory had built up enormous long-term capital, huge intellectual capacity, and maybe most importantly, a really patient long-term national strategy.
A strategy focused on tech sovereignty, not just quarterly trade figures.
Precisely. They weren't dealing with some reality show contestant. They were dealing with the world's second largest economy, playing a very different, much longer game. It was, checkers versus chess, really.
Here's the twist.
Yeah, this is where it gets interesting.
Instead of folding or rushing back to negotiate under pressure, China's response was quite different.
It was strategic patience, wasn't it? While the U.S. was focused on blocking imports, Beijing just quietly started diversifying, opening up new global trade windows.
Bypassing the U.S.
Completely. They clearly understood it was an endurance game, so systematically they shifted supply chains. Think about agriculture.
Soybeans.
Soybeans, exactly. They cut back on U.S. purchases and locked in deals with Brazil. Beef started coming more from Australia, oil imports, diversified to Canada, the Middle East.
So this pivot basically pulled the rug out from under U.S. industries that relied on that massive Chinese market.
Instantly. We're talking 1.4 billion consumers, a guaranteed market that suddenly wasn't so guaranteed for American farmers, energy producers.
And the irony gets even sharper when we talk about semiconductors, right?
Right.
The most critical tech.
Oh, absolutely. The U.S. export controls were designed to, starve China of advanced chips, hobble their tech ambitions.
Triple their roadmap for AI, advanced computing, that sort of thing.
But instead of poison, it acted more like a potent industrial vitamin.
How did that happen?
Well, look at a company like NVIDIA, an American giant. Before these restrictions, they apparently had something like 95% of the high-end chip market in China. Huge.
95%. Wow.
Now, because of U.S. regulations blocking sales, that market share is effectively zero, or close to it. Zero large, as some put it.
So the U.S. basically forced its own companies out of a massive market.
Sacrificing billions in revenue and, crucially, handing the entire domestic market over to emerging Chinese competitors, it was almost a gift.
But could China actually fill that gap? Did they have the capability then?
Well, they were forced to develop it, weren't they? The sanctions essentially acted as a catalyst.
Right.
They mobilized enormous amounts of state and private money into building their own semiconductor industry, and at incredible speed.
We're talking about companies like
SMIC, Cabric, Huaheng. Now, okay, they might still be behind the absolute cutting edge, say, TSMC in Taiwan.
Sure.
But the pace of progress is key. A few years ago, getting beyond 28-nanometer chips was a major struggle for them. Now, they're making 14 millimeters, even pushing towards 7-millimeter equivalent chips, often with huge government backing.
So the very policies designed to stop their progress
Ended up accelerating their drive for self-sufficiency. It probably sped up their timeline significantly compared to what might have happened otherwise.
It's really a striking example of unintended consequences, policy driven by maybe impulse rather than a long, hard strategic look.
If you're finding these insights useful, take a second to subscribe to Geo9. It really motivates me to keep sharing more research stories like this.
Okay, so we've established this picture. The U.S. perhaps hurting its own companies, unintentionally speeding up China's tech independence. Let's talk about the leverage now. The so what?
Right.
Where does the U.S. still find itself?
Right.
Well, exposed.
Right, because the focus often stays on consumer goods trade, but there are deeper dependencies. Two areas stand out.
No.
First, just basic supply chain vulnerability. Despite all the talk about reshoring since 2018, the reality is the U.S. still relies heavily on China for absolute essentials.
Like what, specifically?
Well, think about pharmaceuticals. Over 95% of the antibiotics used in America, ibuprofen, still originate in China.
95%. That's not just trade dependence.
No, that's a fundamental strategic weakness, a national security issue, really.
And the second area, the ultimate card, you called it.
Rare earth metals, those 17 elements, they're the secret sauce in almost everything high-tech.
Your smartphone, EV batteries?
Exactly. Wind turbines, advanced jet fighters, guiding systems. All of it relies on these metals.
And China's position here is?
Dominant doesn't quite cover it. They control something like 85% of the global production of these raw ores.
Okay, that's a lot.
But here's the kicker. They control nearly 99% of the refining and processing, turning the raw dirt into the usable high-purity metals and components.
99%.
So effectively, the modern technological world, it literally stands on metal that has to go through Chinese processing plants. That's immense leverage.
It really flips the original trade war assumption on its head, doesn't it?
Yeah.
The idea that U.S. held all the power because it was the biggest buyer.
That whole theory rested on China collapsing without U.S. consumer dollars. But the data just doesn't support that anymore.
China has decoupled, you're saying, strategically.
It looks that way.
Yeah.
They've been quietly reducing their exposure. Look at the trade figures. Chinese exports to the U.S. as a share of their total exports have dropped, down from around 17% to maybe 12%.
Okay.
And when you measure that against China's massive overall economy, exports to the U.S. are only about 2% of China's GDP.
2%. So if the U.S. stopped buying everything tomorrow?
China would feel it, sure, but they could likely absorb it without major disruption. Barely blink, perhaps. Meanwhile, the U.S. economy, its hospitals, its defense sector, still deeply reliant on made-in-China essentials and those critical rare earth materials.
Now think about this. Those tariffs. They were sold as protecting U.S. jobs, punishing China.
Right.
But who actually ended up paying for them?
Well, economically, the importer pays the tariff, not the exporter. That cost gets baked into the price for U.S. businesses.
Which they then pass on
to the consumer. So, yes, the tariffs effectively acted as a tax on Americans. Many analyses point to this as a key driver pushing up inflation domestically.
Like the cost of everyday goods. Cars.
Exactly. The example often cited is the average price of a new car soaring past $40,000. The aim might have been China's trade surplus, but the impact was felt directly in the American consumer's wallet. And it added to the national debt burden, too.
And this economic cost is happening against a backdrop of, well, a pretty different political environment compared to China's, wouldn't you say?
Oh, absolutely. You see the U.S. grappling with what looks like significant political instability, the stock market reacting wildly to, single tweets or political shifts, almost like a political casino. And at the same time, national debt is just ballooning, past $37 trillion now, that kind of volatility. How does that look to global investors?
Compared to China's approach.
The contrast is stark. While the U.S. seems caught up in these short-term political cycles and trade fights, Beijing appears to be playing a much longer, quieter, more calculated game.
Focused on
securing future resources, building political alignment. They're forging these huge trade and infrastructure deals, especially across what's sometimes called the majority world.
The Middle East, Africa, Southeast Asia.
Exactly, investing massive amounts in ports, railways, energy projects. But the framing is different now.
How so?
They seem to be positioning these nations less as just markets and more as, partners in a potentially new economic order, often emphasizing non-interference in internal politics.
Which might appeal to countries wary of conditions attached to Western aid or investment.
Precisely. It's building a kind of diversified geopolitical safety net for China, while the U.S. is perhaps more inwardly focused or tied up in its traditional alliances and rivalries. Now, there's an important nuance here. We should be clear.
Okay.
While China holds this huge leverage, especially with rare earths now, they did make a bit of a misstep a few years back.
When they threatened to restrict exports.
Exactly. That threat, while maybe effective short-term, definitely caused global panic, and it acted as a huge wake-up call for everyone else.
Prompting other countries to
Scramble, to find alternative sources for rare earths, or, more importantly, to invest in developing their own processing capabilities. We're talking Vietnam, the UK, Australia, others.
So that could eventually chip away at China's monopoly.
In the very long term, yes, it poses a risk to their current dominance. But building those alternative supply chains, especially the complex refining part, that takes years, maybe decades. So the leverage is real today.
But the immediate fallout right now from all this, the trade war effects, the U.S. political volatility seems to be this crisis of confidence.
You can see it quite tangibly, actually. Global investors, even traditional U.S. allies, seem to be hedging their bets, losing some faith in the long-term stability of the dollar, maybe, or the predictability of U.S. policy.
And you see that where? In markets.
Look at the price of physical gold, breaking well over $4,000 an ounce recently. That's not just speculation. Many see it as a flight to safety, a sign of distrust in fiat currencies when national debts are soaring and politics are unpredictable.
While China.
Well, China has been, very quietly, accumulating massive gold reserves, bolstering its own financial standing outside the traditional dollar system. It's another piece of that long-term strategic puzzle.
So the overall picture that emerges from this analysis, it's that U.S. leadership might still be operating under maybe an outdated playbook.
An illusion of past greatness, perhaps, clinging to a 1990s view where power was primarily about dollars and warships.
That the game has changed.
Fundamentally. Power today seems increasingly measured by who controls the advanced chips, who controls the critical metals needed to make everything, and who has secured access to global markets through long-term infrastructure and alliances.
And in those key areas.
Beijing appears to have quietly, patiently taken a significant lead, partly by capitalizing on strategic errors born from, well, maybe short-term thinking elsewhere.
So here's a final thought to leave you with. Given this shift, this concentration of power over essential technology, what does that really imply for the future stability of any global currency, when the ability to produce the world's vital tech rests increasingly with one major geopolitical player?
It's certainly something to mull over as we watch this new era unfold.
So what's your take on this? Share your point of view in the comments below. And if you haven't already, subscribe to Geo9 so you don't miss future insights.